Good afternoon and welcome to today's Investor Signals Premium Account ASX Top 50 Market Update for the month of July. Any individual reader or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hein, Managing Director of Global Equity Management and the Investment Manager for the Investor Signals Unit Trust. I have over 17 years of experience in the financial services industry as a licensed securities advisor. The format for today's presentation, a quick summary of the macro update. Today we roll through the ASX Top 50 with a specific look at the FY 14 earnings, which will begin to be announced in August, and a particular focus on the outlook for financial year 15 from an earnings per share and dividends per share perspective, and identifying where valuation exists and future price targets based around those companies that are likely to deliver earnings certainty in FY 15. As I roll through the top 50 stocks, I'll discuss our recent transactions and conclude with a short-term market outlook on the Australian market. The services that we provide are based around a premium account service, which is a model portfolio of ASX top 50 stocks. We utilise the benefit call options to enhance portfolio returns, combined with effective ownership around dividend dates. We look for above average cash flow as a result of the dividends and call premium while still delivering some capital growth. It's all managed under a strict investment mandate, therefore it's suitable for the self-managed super funds, and the assets remain in your name. If you'd like more information about the Investor Signal service, please contact me using the details on screen there. Moving straight into a graph of the Dow Jones. Now, the US market, we're seeing the beginning of earnings season commence. We've seen Alcoa, Citigroup, JP Morgan. As a general rule, the S&P 500 on an annualized basis is going to deliver a minimum of $115 of earnings per share. Some analysts are as bullish as seeing that growing to $125. If we take the sort of more conservative end of that range, we say on a 14 on a times multiple, the Dow Jones is worth about 15,500 points, and that 10% that I've highlighted there on screen indicates where I think the risk to equities are on the downside, albeit that I don't think that's a highly probable outcome. I think what we're likely to see is a slight uptick in US GDP throughout the summer period in the Northern Hemisphere. That should underpin equity valuations, combined with the comments from the Federal Reserve that the prospect of raising interest rates is probably, it appears to be a good 12 to 18 months off in the US. So I think what we're likely to see is a point where valuations start to get a little bit stretched, and I think we're close to that range now, and we get a period of consolidation. We'll watch the US earnings with a great deal of interest, and in the August report I'll provide a full summary of the US earnings. From our domestic market standpoint, on the XJO, we're trading at about 15 times forward earnings. The market's pricing in about 8% earnings growth in FY 15. I think a lot of the industrial stocks are fairly fully priced, and I'll look at those as we move through the top 50. Where I think we could get an uptick in the Australian market is if the banks deliver earnings slightly above forecast, and likewise if the resource stocks start to recover, or spot commodity prices start to recover, which underpins the outlook for BHP. A share buyback by BHP from an index weighting perspective will certainly help with our market, and we're seeing the early stages of some recovery there in Rio, and I had spoken in prior weeks about the capitulation point being reached in the iron ore trade and the prospect of those stocks putting on 10 or 15%, and that's exactly what we've seen. So from these levels, I think on just over a 4% dividend yield, the argument is, and I'd highlighted that at around sort of 5,300 was a good buying opportunity on any pullback. The market pullback touched that range, and we're now back up to around 55. It's only with that contribution of the banks and the resources that we may see a push higher to 5,700. As I roll through the top 50 stocks, you'll see that a lot of the industrial companies, there's not much margin left for share price expansion, and likewise within the property trust sector. On that note, let's move straight into the top 50. And so AGK, I like the outlook here for AGK from a valuation standpoint. The stock's trading about 14 times next year's earnings, so when I refer to forward earnings, meaning FY15, it's on about a 4.3% dividend yield, and that allows for roughly about 8% earnings growth in AGK. I think they can deliver that. I think it's a buy down here at $15 that I mentioned, up at around $16.50. You want to be capping it and selling the covered calls. But outlook there for about 8% earnings growth. Asiano still not doing here at the moment, not much in the top line, way of top line revenue growth. The stock's only delivering a 2.6% yield, and most of that profit growth coming through cost cutting. So I think there's better opportunities elsewhere in the market. Amcor. Expectation for about 8% underlying earnings growth. The stock trades on about 15 times earnings and on a 4.5% dividend yield. I still maintain that around $10 it's a buying opportunity. Up at around $11 you need to be looking to selling covered calls. AMP, a little expensive, about 17 times forward earnings, 5% dividend yield, but I think there's some question marks over the consistency of the earnings trend within AMP. The Australian banks, I'll just say that they're all roughly the same, delivering maybe somewhere a minimum of 3% earnings growth, expectations around 5% earnings growth. Anything north above that is effectively going to help to push a further advance in share prices. But at around 5.5% yield, I still think it makes sense to have exposure to the banks. In most cases, we own them at lower levels. On the rally up, we've sold the covered calls. So I think we're sort of sitting at a reasonable outcome here. If it bounces sideways, instead of just collecting that 5.5% yield, we're getting about 10% cash flow out of the banks. ASX, I think this is a must-have in portfolios. From a valuation standpoint, about 17 times earnings on a forward yield of about 5.2%. The market's not looking for much in the way of earnings growth, maybe up to 5%. I don't think, given current volumes that we're seeing in the market, there's probability of surprising there on the upside, but it's a good stock to have in portfolios. Combine that with a call option, you're getting about 10% cash flow, and I don't think there's too much downside risk to ASX. AZJ, we like this name. We're buyers of it at this lower levels. As it's rallied up, we're now looking to get the covered calls away at around this 5.25 level into the end of the year. That turns sort of the dividend yield of sort of 3.5% again into about 10% cash flow and good capital growth if we owning it at 480 and delivering it at sort of that 5.25 level into the end of the year. But continue to like AZJ. The market has a pretty bullish growth expectation on earnings, growing at around 25%. 20 to 25%. We're taking a little bit more of a conservative view, but continue to like AZJ. I think that's a cornerstone stock for portfolios over the next 12 months. BHP, we own this at lower levels, fitting in with this picture that I spoke about in the prior recording about the iron ore capitulation, BHP being our preference to have exposure here. The stock trades about 13 times forward earnings on a 3.5% dividend yield. The market's really ratcheted back its expectations, and has suggested that we have flat earnings from 14 into 2015. I think the surprise here might be when BHP announced a share buyback during the August earnings results. As it gets up to around this $38, $39 level, we'll look to sell covered calls up at around $40.50. We're trying to get around 70, 80 cents for those, so giving us an effective exit price back above $41. Combine that with the upcoming dividend, the prospect of a share buyback, I think we're sitting in an okay position there on BHP. Brambles, expensive, 20 times earnings, 3% dividend yield. The market's looking for about 10%, 8 to 10% underlying earnings growth. Happy to buy it on any pullback at or near $9. At around $9.50, we look to sell the covered calls. CBA, same comment there applies as to all the banks. Coca-Cola, so interesting here. Let's put some numbers on this. What I'm thinking is going to happen is Coca-Cola will rally into the upcoming dividend. There's a new CEO in place. I think we have to allow about 6 months for her to articulate what any sort of turnaround strategy in the business is going to be. I'd expect to see that by the end of this year. I think in that environment and under that announcement, the stock could trade back to $10.50. But even coming into the upcoming dividend, the stock's on a 5.5% dividend yield. The company in 2015 should still pay about 50 cents of dividends, and I think that will support a valuation about $10. At that point, it's worth trying to sell the calls, drive some extra cash flow while we're waiting for the stock to recover, turn that 5% yield into around a 10% yield. But I do see that the Coca-Cola business delivering about 400 $480 to $500 million of annualized profit. I think there's still a turnaround opportunity yet to play out here in Coca-Cola. Computershare, expensive up here, even on forward earnings, 22 times earnings, 2.5% yield. We really like the Computershare story and the international distribution that the business has, the push into the US over the last few years, but really we want to be a buyer of it on a market pullback. So at around 11.50, we're happy to take another look at Computershare. CSL, I think we could see this company announce a further share buyback, maybe up to another $900 million. I think if that happens in the August earnings result, it underpins the share price. But even with the company delivering 10% underlying earnings growth, I think there's reasonable value here at the current level. Crown, I'm interested in Crown, but at 15 times forward earnings, 2.5% dividend yield, and the market already paying up for in excess of 10% earnings growth. A little like Computershare, this is a real buy on the dip story, and we'll keep an eye on sort of market volatility as to, from a timing standpoint, when it produces buying opportunities in some of these names that I consider to be a little more of a trading name rather than these defensive income names that we're drawn towards for portfolio allocations. But from Crown's perspective, should deliver around $1.05 earnings per share, pay out about 38 cents a dividend, which puts it on, as I said, on a 2.5% dividend yield. Goodman Group within the property play. Now, these property names continue to compress down to low dividend yields. In the case of Goodman, there's about 8% underlying earnings growth. The stock should deliver around about a 4.5% yield. I think the argument here is anything as it compresses much down below 4% surely gets expensive, and you're not getting rewarded from a risk-reward perspective. So I'd expect Goodman Group to start to at least run into some resistance where it consolidates and moves sideways. Similar story here with GPT, about 7% underlying earnings growth, 14 times forward earnings, 5.5% dividend yield. Look, maybe there's a little bit more room for expansion. We have been owners of GPT at lower levels. We effectively took profit and delivered the stock at this $3.90 level. It does come back onto the radar. Any little sell-off where we could pick it back up at sort of $3.80, we'd certainly look to jump on that opportunity. Continue to like GPT from an outlook perspective when combined with a covered call, turning that 5.5% yield into about 10% cash flow there on GPT. IAG, not doing anything there at the moment. Iluka, look, not one of our core stocks that we'd normally look at, but interesting to read some of the commentary from the CEO recently, and it comes onto the radar as a point where the stock may start to see some fairly rapid share price appreciation from this $8.50 level. And I'll cover that more in the next recording. IPL, this has been one of the high conviction calls where I said here at around this sort of 270, it's time to buy IPL. I think the company can deliver double-digit earnings growth over the next few years. The stock trades on a PE of around 13 times forward earnings on about a 4.5% dividend yield, or about 4.25% dividend yield. But I really think IPL business could sort of start to deliver consistent earnings growth in that high double digits, which the group of stocks within the ASX 50 is fairly limited now that are able to do that. So from a valuation from the short-term perspective, at around $3.10, I think it starts to look full value. But if we probably go out another 6 months, if the stock can trade $3.10, consolidate, I think we could see a rally back up to $3.20, $3.30. Right at the moment, we own it at lower levels. Any push above $3, I'll look to sell the covered calls up at around the $3.20 level, trying to get 10 or 12 cents for those, so effectively giving us an exit price up at around $3.30 towards the end of the year. I wouldn't expect this rally to take out that $3.30 level, so it should be a fairly safe way of driving extra income out of IPL. James Hardie looks good. It is expensive at these levels, but certainly all the data around US housing market would suggest that there's a lot further to go in the US recovery. Lendlease, this is a buy on the dip opportunity, 12 times earnings, 3/4% dividend yield. The market's looking for almost 10% earnings growth in 2015. As I've maintained, from 15 through to 17, 18, I think will be good years for Lendlease, and it's a buy on the dip. So I'll just sort of shift this forward through to this area here. If we have the opportunity to pick the stock up at around this 12.75 level, 12.80, we're certainly keen buyers of it there. Mirvac, interesting within the property play, trading about 15 times earnings on a reasonably solid dividend yield. Macquarie, the concern here is forward earnings growth of around 20% already factored in, 14 times 2015 year on a 5% dividend yield. I think there's room for disappointment if the company can't deliver 20% earnings growth on an ongoing basis, and I think that's a fairly tall ask. So I'd expect to see Macquarie start to consolidate. Within the banking space, NAB still remains the cheapest of the main four. From a yield perspective, it's on forward yield of around 6%, trading about 12 times earnings, and we're still looking for announcements out of the company about the restructure or spin-off of the UK banking assets. All the banking stocks essentially the same, 3% underlying growth conservative, 5% is the benchmark. Anything above that we see a re-rating in the share prices. Newcrest, we've started to see a little bit of a recovery here in Newcrest. One could argue that it's a result of the escalation of conflict in the Middle East, or it could be that we're starting to see some focus on the potential of inflation building within global equity markets. Now, I think the inflation call's a little premature, but the argument would go that as central banks continue to print a lot of money, and we're now seeing the Eurozone step in and do that, the prospect of inflation coming through down the track starts to increase. But Newcrest, I think, as I've spoken about, it's a long, slow recovery over the next few years. The stock could trade up to around $17 to $20 over the next, I think, 12 to 24 months. I don't see too much more beyond that. Origin, so fairly expensive, as I've maintained, at $15. It was time to sort of take profit or get aggressive with selling the calls. The stock's trading 19 times forward earnings on a 3.5% dividend yield. It's time for the company to reassure the market and deliver 10% earnings growth. We've seen pretty disappointing earnings trends over the last 24 months from Origin, but around $14.30, I think it's a buy on the dip at or near these levels. The prospect that the company may do a rights issue, I think, is reason enough to have some exposure to Origin ahead of that potential rights issue, but we've been pretty aggressive with selling the covered calls over Origin to drive the extra cash flow, trying to turn that dividend yield into a higher return. Oil Search, we've just started really taking profit on Oil Search. Our preference is Santos now, as we have taken profit on Woodside also. QBE, interesting here that the market's starting to get a little bit more bullish towards the earnings outlook, so it comes onto the radar, but around 12 times earnings, 4% dividend yield. It's interesting that the company certainly has a long history of missing its earnings guidance, so it's not until we start to see either the interest rates rise in the US or the company actually deliver on their forward guidance that we start to really concentrate back on QBE. Ramsay Health Care, great business, growing earnings over the next 12 months, somewhere around 15%. The expectation is for it to deliver around 2% dividend yield, so it's a compelling safe haven, but you are paying a premium for it. So we have it as a high conviction, but really not doing too much there at the moment as far as reallocating capital to it, but it's certainly on the radar. Rio, I've spoken about the sort of capitulation in the iron ore trade. We're starting to see a recovery there in Rio, allowing for some uptick in earnings in Rio, around about 7% over the next 12 months, puts the stock on about a 3.5% dividend yield and 10 times earnings. My preference still remains BHP, though, in light of them likely to be the one that announces a share buyback ahead of Rio, I think. SCG, so this is the old WRT, so we've had the spin-off and the restructure of Westfield into Westfield Group, and we've seen Westfield Retail Trust become Scentre Group. Now, from a valuation standpoint, the stock's put on about roughly 20% since spin-off, and it's really hard at the moment to get our head around what the new earnings outlook for the consolidated entity looks like. We've got the prospect of some potential asset sales coming up as they look to reduce their gearing a little. Whether those asset prices fetch the ultimate price outcome that the market's looking for, that'll impact valuation. I'm inclined to look at taking profit on SCG up at these levels, let the dust settle. I think the better investment is WFD with the international exposure, and I think we just need to give the Australian entity here another few months to really see some better data come out as to what the earnings outlook looks like. What we're seeing at the moment is this stock compressed down to about a 5.5% dividend yield in line with the rest of the property plays, and therefore I think we're probably looking at the top end of the valuation range at the moment. Stocklands, we've collected the dividend on Stocklands at the end of the June period there. That was approximately 12 cents. The stock's recovered most of that dividend, in a space of the last few weeks at around $4. It puts the stock on a PE of around 14.5 times earnings on a 6% dividend yield. The underlying business is growing at about 7-8%. I think it makes sense to continue to have exposure to Stocklands in portfolios. As is the case with Sonic, I think this is an opportunity where we've been buyers of it on the pullback at around $17. Coming into the August dividend, I can see it trading up to around $18. We'll sell the covered call at around $18.50, turn that dividend yield of 4.5% into about 10% cash flow. On a valuation, the stock trades at about 16 times forward earnings on about a 4.25% dividend yield. Underlying business is growing about 7%. So I wouldn't expect the stock price to trade too much above $18.50. So another one of those good defensive cash flow names for portfolios, a little similar to ASX in the context of considering it from a risk profile. So I think it makes sense to have Sonic in portfolios. Santos, I think this is the undervalued gas play now. So we're owners of it here at lower levels. Up at around $15, I think it probably looks full value short term, but certainly into the middle of next year I think we could see Santos trading much higher levels, so happy to have exposure there in portfolios. Not doing it there in Suncorp nor in Sydney. Transurban, we've been beneficiaries of owning this at lower levels. The stock's extremely strong from a dividend yield standpoint. It paid about 34 cents of dividends in 2014. In 2015 we see that kick up to about 38 cents. That puts the stock back on around 5% yield. Again, it surprises me just how strong the underlying earnings trend in Transurban actually is. I'd expect that surely we get into a period where we get a consolidation, but I'm still happy having a focus on Transurban within portfolios. Likewise, Telstra, our base case here has been we want to own it coming into the August dividend. We're seeing the stock price quite strong. There's speculation that the company may announce a $2 billion share buyback in their August earnings results. I think the cap's around $5.50 here in Telstra. If you back out, let's say it gets up to $5.50, we back out the upcoming dividend, you'd see the stock back at around $5.35, and we'd probably get another consolidation at or near that level going into December. But to continue to like Telstra coming into the dividend, and for my money, I think sort of taking profit on SCG and putting it into something like Telstra continues to make sense. To take advantage of probably more capital growth and a quicker payment of the dividend, upcoming dividend. Toll, not much here in the way of earnings growth, limited, maybe sort of 3% earnings growth. From a yield perspective, the stock's trading on about 12 times earnings and a 5.5% dividend yield. We want to be selling calls at around the $5.50 level. Westpac, I've covered that in the context of all the banks. Wesfarmers, to put some numbers on this, now trading about 18 times forward earnings on a 5% dividend yield. The market's looking for pretty flat earnings growth from 14 to 15 in Wesfarmers. I think we've been buyers of it down here on the pullback at 41, up here around 43. The aim is to sell covered calls out into next year up at around $44.50 to $45. If we can collect sort of $1 for those, plus collect both the August dividend and the February dividend, I think that delivers a good cash flow defensive name for portfolios. WFD, I've chatted about that underlying earnings growth about 5%. I think it's probably the slightly more attractive of the two from a longer term growth perspective. Woolworths, to put some numbers on this one, about 17 times earnings on a 4% dividend yield. The market's looking for about 5% underlying earnings growth. Woolworths doesn't pay its dividend until September, so it might be a little bit later in the rally into the div, but I still think at around this level Woolworths is good value, providing you're selling the covered call and turning that 4% dividend yield into sort of closer to 10% cash flow. Woodside Petroleum, we own it at lower levels at around $42, $43. I started to suggest it's getting a little expensive. The stock does offer a compelling dividend yield around 5.5%. We are seeing comments and acquisitions out of the company where they're trying to rebuild the pipeline of growth prospects within the LNG or oil and gas space. Any pullback below $40, be keen to take a look at Woodside, but probably at the margin Santos is slightly better value at present. And then we have it back to AGK. So in summary, the Australian share market, I think we're in the early stages of the US earnings, so we'll watch that with interest. And then certainly as we move into the August Australian reporting season, I'll cover the earnings results of the ASX Top 50 in a lot of detail. Thank you for listening to today's recording, and if I can help you out with chatting about further details on the Investor Signals Model Portfolio Service and how we can work in partnership with you to manage your superannuation fund or your share portfolio, please contact me using the details on screen.